we are going to be looking at the volatility 10-1S at the H1 time frame only. The red line is the 6 exponential moving average. The blue line is the 12 exponential moving average. We start to confirm a signal when we get a crossover. For example, when the red line is above the blue line, that is going to be a bullish signal. And when the red line is below the blue line, that is going to be a bearish signal. Red line above blue line, signal to buy. Red line below the blue line, signal to sell. We also have the MACD, moving average convergence divergence, and then we have the ATR indicator. On the MACD, we have these blue bars and then we have this red line. Then we have a zero line right over here. When the blue bars are above the zero line, that is a bullish signal. When the blue lines or the bars are below this blue line I have drawn, or the zero line, that is going to become our sell signal. There is what we call momentum. When a momentum is decreasing, you will find that these bars have been rising and then here they start to decrease. When these lines are hugging the red line, that is a strong momentum. When the bars stop hugging the red line, that is a reduced momentum. Right here we have a bullish trend or a bullish momentum right over here. When you look so keenly, you can see that right over here the bars were hugging this red line, and then on different side here the bars were not hugging the red line. That is when the momentum is decreasing. So here we are going to be trading momentum. So when you look right over here, we have a signal to buy. This signal is happening on this tiny candle or a doji. And then when you look right down here, the momentum is also positive. It shows from here the momentum was for selling, but right here the momentum has changed. The bars are no longer hugging the red line. So we have a momentum which has changed. When the momentum changes and then here you get a signal to buy, then you can take a long trade. So when you look at this candle, right over here we got a signal to go short. The red line is below the blue line, and then right over here the momentum has also decreased, because from the previous side we can see that the momentum was increasing, which was a buying momentum. So when your selling momentum goes in, the momentum starts to decrease and then chases to slide below this zero line. We look at this signal candle and then we confirm with the momentum, which is for selling, and then we take our trade. Don't use market orders. Come and put here your sell stop order, and then you put a stop loss. When you're putting your stop loss, you have to use the ATR. The ATR setting is at 14, and then the MACD setting is at 12, 26, and 9. When you look at the ATR indicator, right now it is reading 15.63. So you have to multiply this value by 1.5 to get a stop loss. You drive your stop loss from your entry point. For example, if this was our entry point, we have to move 15.63 times 1.5. That will be around 25. So you will come to your entry level, and then you drive 25 pips away from your entry point. So our stop loss will be around here. So you will come and put your sell stop order, and then you put your sell stop. The take profit is supposed to be 3 times of the ATR, or 3 times of the ATR away from your entry point. If this was your entry point, you have to read the ATR value, which is 15.63 times 3, and then you put it away from your entry point. So for this case, our take profit would be around here. When you look right over here, we got what we call a bullish signal. How did we confirm that bullish signal? You come right over here and then you look for where the cross happened. The cross started at this candle right over here. So you check for the momentum. Is the momentum being driven away from the red line? Right over here, you see that the momentum is still hugged on this red line. So you wait for the next candle. If the momentum shifts away from the red line, so for example on this candle, that is when the momentum shifted away from that red line of the MACD. So what you do, you come and put your buy stop order. Don't use market orders. You put a buy stop order, and then you put your stop loss 1.5 of the ATR away from your entry point. For example, this is going to be our stop loss, and then your take profit will be 3 times of the ATR away from the entry point. So for example, right over there, if this is your entry point and this is your stop loss, and then this is your take profit, this candle right over here is already in the money, and then this candle right over here is already in the money, and this candle right over here is already in the money. On top of that, your trade has not triggered the take profit. So what you have to do is to shift the stop loss right away from where it is, and then you come right below the big candles. For example, in this candle, you would shift your stop loss to come right over there, and then your new stop loss will become a trading stop stop loss so that you can be able to lock in some profits in case the market falls back rapidly. So for example, this was our entry point. Our new stop loss is right over here. After getting this big candle, we have to shift our stop loss into the middle of this candle, or at least 1 ATR away from the close of this candle. So the close of this candle was right over here. If this is a close of this candle, you look at the ATR value and then you shift and then you put your stop loss at least 1 ATR away from the close of this big candle. So if this is our new stop loss, then we wait and then see what is going to happen next. So you can see that we keep going and then we can be triggered out. That is one of the best ways to exit a trade. If you don't know where to put your take profits in, you have to use a trading stop loss. If you don't use a trading stop loss, you have to use what we call this 6 EMA as an exit indicator. So when you look at this trade, for example, which we entered from right over here to buy, as the trade goes, we wait for the price to come and close below the 6 exponential moving average, and then we can be able to close that trade. We had entered our trade from right over here, but we wanted to catch more profits as the price moved toward our take profit, and then we shifted our take profit a little higher to capture more profits. So what we do, instead of using the take profit level, we use what we call the exit indicator. We use this fast moving average as our exit indicator. So you will come and look at how the price is moving away from this exit indicator. So the price will move far away and then try to come back to hug it, and then it keeps moving. So you can see that right over here, the price has closed below the fast moving average, which is the 6 exponential moving average. So from this candle right over here, we can close our trade, or what we do is to shift our stop loss a few pips away from the close of this candle, which has closed below our 6 exponential moving average. It is in forex trading, there is nothing that is holy grail. So this strategy is going to be having some difficulties. One of them is to avoid choppy markets. You can see that the market was choppy. The market had a lot of indecision from all this side. You shouldn't have trade to trade. So how would you capture this? You look at this trade right over here. It has momentum and everything. You have put your buy stop order. The market has not triggered you. So this buy stop order has served you this trade. But right over here, you can see that the market is choppy. So you don't trade in that period. You wait until the market has cleared. One of the best ways to confirm that the market has cleared is by forming candles which have shorter tails. When you see that the market is forming candles which have very long tails, you have to get away from that market and wait for the candles to stabilize. So for example, right over here, you can see this bullish engulfing, which is very clear. So we should have taken our new trade from right over here. So we avoid choppy markets. Another drawback from this trading strategy is that we are going to be using only one time frame, and that is going to be the H1 time frame. We don't look at the 30-minute. We do not compare different time frames. So for trend continuation strategies, I recommend, if you're a complete beginner, to stay away from them. Let the market move and capture what you've captured. For advanced traders, in this strategy, for example, right here, you had a signal to sell. But if you sold from here, there is a chance that your trade was triggered out from around here because of that trading stop loss. So you wait to get a continuation strategy, and continuation strategies are gotten using what we call either moving average bounces off or the market structure of breathe in, breathe out, or price high, price low. So for example, right here, you can see that you have a candlestick pattern, and this candlestick pattern signals a sell. We have a big bullish candle followed by a tiny bearish candle, and then followed by a strong bearish candle. This candlestick pattern can be used, for example, to capture a trend continuation. So we would have gotten our trend continuation from right over here. Right over here, if you had made your trade from here, you would have captured a trade from up to around here, and then you exited. So after forming this small retracement within the market, you would have captured your trend continuation from this candle. If you're a complete beginner, study more about continuations, or comment, share, and then you subscribe to the channel for more videos like this.